Learn everything you need to know about the stock market with our beginner's guide.
From this video, we will learn about initial public offerings, popularly called IPOs. We must explore IPOs from the perspectives of investors and companies, because typically, corporations sell IPOs and investors buy them. Let's try to understand IPOs from the standpoint of the company, before talking about Rahul's intentions for his investment in IPOs.
David bakes some delicious cookies. His social circle knows him well for these cookies. His family and friends encouraged his decision to start a business, selling these cookies. Although David enjoys the concept of launching a business, he lacks the necessary funds to do so. David approaches one of his wealthy friends to provide him with money in return for some company shares. With this initial funding, David launches his business operations. The first round of funding is referred to as the seed round. After a year, David's cookie company is growing, but to keep up with the high demand for his products, he has to hire more employees and purchase more raw materials. He requires additional funding to satisfy the demands of his business. This time, David contacts a city-based HNI or high net worth individual who frequently invests in new startup ventures. These HNIs are also known as angel investors, since they invest in new startups and guide them through the process, using their experience and resources. David is able to raise funding from an angel investor in exchange for company shares. After a few years of successful business, David intends to increase the manufacturing unit's efficiency by upgrading the equipment and purchasing new machines. However, the question remains, where will he get the money to make these improvements? This time, David chooses to approach a venture capitalist to raise the necessary funds. A venture capitalist is an investor who is willing to invest in a business in its early stages. In exchange for the funds, David will also give the VC some shares in the company. This round of investment is referred to as Series A funding. David is able to produce many more cookies in less time thanks to the Series A funding. The company's popularity continues to rise, resulting in an increase in revenue. 2 more years have passed. The company is doing fantastically well. It has built a presence throughout the state and in several other parts of the country. However, the company now wants to expand its activities across the country, which will require more funding. This type of expenditure, which is planned to improve the overall business, is called capital expenditure, or CAPEX. David can again go to the venture capitalist or big investors to raise capital, but they might not be willing to give a fair price for the business, or he can get loan from bank, but this will also increases his debt and he needs to pay interest for huge loan. The best way for David now is to go and ask the public to invest in his company. Technically this way is called IPO. Initial public offering, IPO, is a way to raise capital and issue shares to investors that will be tradable on a stock exchange like NSE, BSE. Basically transitioning from private company to public company. David now wants to take the IPO route for developing and expanding his business. With the help of IPO, David can raise sufficient funds for business, can reduce the cost of the capital since the funds raised are interest-free, build a brand image for his business, because customers can trust a public limited company, and even, it can provide an exit opportunity for his angel investors and venture capitalist. David can't just go and register on the stock exchange for an IPO. There are a series of steps involved in going for an IPO. Let's see what these steps are. First, a merchant banker needs to be chosen. The merchant banker will help David's company do its due diligence, right from preparing the application till the listing date. The merchant banker will assist the company. The second stage will be to apply to SEBI, with a registration statement that includes information about the company and why it intends to become public. The third stage is to obtain SEBI permission. SEBI will decide whether or not to approve the IPO based on the registration statement. The following stage is to get ready for the DRHP. The Draft Red Herring Prospectus, DRHP, is a document that comprises all of the company's information as well as the financial statements. The DRHP is made public so that individuals can research the firm before investing. The company can now do the promotions for IPO, like conducting TV shows, promoting in social medias, going for TV and print ads. The company can now establish a price range. A pricing band is the range of prices at which the company seeks to go public. Following the opening of the shares, for subscription to investors, participants will select a price within the price band that they believe is fair for the IPO. All of these price points are gathered as part of the book building process. It is now time to decide on the listing price, which will be the price point at which the most bids were received. Finally, the listing day, which is the day the company is listed on a stock exchange. The listed price is decided on the basis of the market supply and demand. The share price of newly listed company may be at a premium or discount. The primary market is where an investor can buy shares of a company that are issued for the first time through the process of IPO. Many Indian companies have gone through this process, in order to raise the capital they require for business expansion across the country and around the world. One such example is Zomato. Deepinder Goyal and Pankaj Chadha started Zomato as Foodie in 2008. It began as an app-based restaurant discovery service, where users could search for restaurant menus, but it has now grown to capture about half of the market share for food delivery. Zomato has raised a total of $2.1 billion in venture capital funding in its brief existence. The most recent money was obtained in February 2021. This was Zomato's final round of venture capital fundraising before going public in July 2021. Zomato offered to raise 9,375 crore of rupees through the IPO at a pricing range of 72 to 76 rupees. The face value of the Zomato share was 1 rupee. The issue was oversubscribed 38 times in total, with individual investors contributing 7.5 times. The issue was offered for the secondary market, on the NSE at an exceptional listing price of 116, a 53% premium over the IPO price of 76 rupees. Zomato's current market value is $5.3 billion, and since the IPO, Zomato's revenues have climbed by 75.01%, from 692 crore of rupees in March 2021 to 1,212 crore of rupees in March 2022. This example shows how an IPO may assist a company gain recognition among the general public and scale the business to a new level. In the next video, we'll look at IPO from Rahul's perspective as an investor.